Hello and welcome to my InvestEngine portfolio update for December 2024. As you may have seen in my recent video, I've started contributing to a SIPP on InvestEngine as well now. So from now on, these updates will be monthly stocks and shares ISA and SIPP portfolio update videos. In terms of news this month, I'll cover the market more in my Trading 212 update, which may be before or after this video, I don't know yet. And in this video, I'll focus on probably the most discussed thing this month, which is the change to the Vanguard platform fees that will take effect from the 31st of January 2025. Now, I didn't rush to make a YouTube video on this at the time because I felt I could get my point across with just an email and community post, but let's just quickly reiterate why this is such a shocking and arguably misjudged decision by Vanguard. I've heard a lot of condescending takes on this, with some people saying, oh, it's only £4 per month, what's the big deal? I think many people making this argument are completely missing the point, and that point is that Vanguard is meant to be a low-fee platform that makes investing accessible for everyone. Now, how can that be the case if I wanted to start investing from 2025 and could only afford £100 per month, which, let's be honest, can still make up a significant part of people's monthly budgets? And now to start this £100 per month investing on Vanguard, you're basically paying a 4% contribution charge. You may be depositing £100, but you're actually only getting £96 to invest. And it's going to take at least a few years before that £4 per month stops being a significant percentage of your portfolio. Converting it into a percentage charge is the best way of seeing why this change is such a big deal. Let's take a look at this at different portfolio sizes and how it compares to Vanguard's previous fee structure. For a £1,000 portfolio, the £48 per year platform charge equates to 4.8% of your portfolio, and this is not even taking into account fund costs as well, remember, which also goes to Vanguard because they only offer their own funds. At the previous 0.15% account fee, the annual platform fee for a 1k portfolio was £1.50 a year. This is some off-the-chart level increase by Vanguard here, and what a kick in the face it is for beginner investors. At a £2,500 portfolio size, the £48 equates to a 1.92% annual charge. At the previous 0.15%, it was only £3.75 per year. For a £5,000 portfolio, the £48 equates to a 0.96% annual charge, and this is up from the £7.50 per year it was at the 0.15% account charge. And then for the last example, for a £10,000 portfolio, the £48 per year equates to 0.48% annual charge from the 31st of January, up from £15 per year at the 0.15% it currently is. I would ask those people being condescending here, would you be happy to pay this level of percentage fee on your portfolio when there's so many cheaper options available? I know I certainly wouldn't. And yes, for those with account values above £32,000, there is no change and it remains at 0.15% capped at £375 per year, but that is because 0.15% of £32,000 is £48 or £4 per month. So to those with that condescending take of it's only £4 per month, I do wonder how their views would differ if they were a beginner investor again. I'll leave a link to gain access to my investment account comparison spreadsheet in the description. I always keep this updated as best I can, and if you are thinking of either switching platforms or starting to invest and not sure which platform to go for, it should help you with your research. There's a details tab for each type of account covering everything from fees, investment range, whether it has a phone app, and a few other things. But also, of relevance here, there's an example annual cost tab which shows what the platform charge equates to at different portfolio sizes when you invest into ETFs. You can see Vanguard will now become one of the most expensive for smaller portfolio sizes. Before jumping into the portfolio update, I want to make clear that these videos are not financial advice or a recommendation of what to invest in. I'm sharing my own portfolio for informational and entertainment purposes. Please always do your own research before making any investment decision. When investing, your capital is at risk and you may get back less than what you put in. Okay, starting with the DIY ISA portfolio. We can see that the balance now stands at £23,746.92, which is slightly down from the £23,981.63 it was as of last month's update. This is unsurprising since we did have that dip in the S&P 500 and the wider market after the Federal Reserve change of tone on rate cuts for next year. Turning to the portfolio page on InvestEngine, we can see on the maximum performance chart my investment return figure now stands at plus £4,084.86 or plus 27.84%. Switching to the 1 month chart reveals the extent of the negative month, with the portfolio being down by £487.38 or minus 1.88%. We can see it is really from the 15th of December point that the market started to dip down. Again, as I always make clear, these fluctuations are nothing I personally concern myself with. I'm an investor with a very long time horizon, so it's pointless for me to worry about these changes month to month. Not to mention this is an incredibly minor dip in the grand scheme of things. Of course, it could always get worse, but there's no way of knowing for sure. There's been no further contributions as I have no ISA allowance left this tax year. Scrolling down to the ETFs to see how they've done over the past month. First up, the global quality ETFs XDEQ and GGRG are down by £161.55 and £143.95 respectively. It's interesting to note that GGRG is down less. As it does only contain dividend-paying quality stocks, it does tend to, but not always, handle the dips a little bit better than XDEQ. This was the case in 2022 as well. GGRG did not dip as much as other global ETFs. Next up is UC99, the USA Quality Factor ETF, and this is down by £31.78 or minus 0.88%. Then we have ISP6, the small cap S&P 600 ETF, and my position is down by a whopping minus 6.36%. Small caps have taken a bit of a battering since the Fed indicated that change in pace of rate cuts. This is because small cap stocks are much more sensitive to any news surrounding interest rates. And you will notice that whenever the news is positive, ISP6 usually outperforms everything else in the portfolio, and vice versa when hawkish rate cut news comes out. Last in the portfolio is EMIM, the Emerging Markets ETF. This is down by minus £6.54 or 0.69%. So no major movements with this one, and emerging markets does tend to behave differently to the other ETFs in my portfolio, given that all the others contain developed market stocks. Switching to the maximum view now, we can see that XDEQ has been the best performing ETF in the portfolio. GGRG, with its focus on dividend paying stocks, has suffered a bit this year due to it not giving a significant weighting to the likes of Nvidia, but it's nothing that concerns me with the ETF itself as of yet. And even in despite of the small cap suffering this month, ISP6 is still performing pretty well overall. The great thing about InvestEngine is that the return figure at the top of the page includes the realised gains from the previous ETFs I held and also the dividends received, so I can easily keep track of my total return as well as getting the handy time-weighted percentage figure as well. I'll now move on to take a very quick look at the managed portfolio. It is up by 25.22% since the portfolio started on the 1st November 2023. Over the past month, it is down by minus 1.25%, so I think it has handled the dip a little bit better than my main portfolio. This may be due to my portfolio having a greater weighting to small caps, but I'm not too sure from a quick glance. A quick scroll through the maximum performance view does show that the GBP hedged S&P 500 ETF at the top here has done incredibly well, alongside the momentum factor ETF as well. But across the board, I've been impressed by the managed portfolio, and I do believe it has outperformed my DIY portfolio, and that is mainly because GGRG has dragged my returns down slightly. If I'd gone all in on XDEQ rather than GGRG, I would have performed better in my main portfolio. Having an ETF that does not include Nvidia at significant weighting is almost a guaranteed way to underperform the market this year. Although, of course, no ETF or portfolio can be judged by just 1 year, and we must always remember that past performance does not guarantee future results. Let me know if you'd like me to continue this managed portfolio review. I'm thinking of selling it now and just putting the money into the DIY portfolio to simplify things going forward, but be sure to let me know. Or perhaps I can try out the new life plans with this money. Okay, and now the last and pretty new section of the InvestEngine portfolio, my self-invested personal pension. Now, I'm not sure if this video will come out before or after the Trading 212 portfolio update, but basically what I've done is I've sold all the investments in my Trading 212 Invest account, which is a general investment account, and I've withdrawn the cash and added it to my InvestEngine SIPP instead. This is for two reasons really. First of all, it makes sense to keep as much of my investments as possible inside a tax-advantaged wrapper for the long term. And second of all, by contributing to a SIPP, I will be able to reduce my self-assessment tax bill. The basic rate relief is added by the provider, which you can see here is a sum of £875 processing on top of the £250 processing from my previous SIPP top-up I showed in the last InvestEngine video. These both should be added within 6 to 11 weeks by InvestEngine. However, as I do have some income falling into the 40% tax bracket this tax year, I can also claim additional rate relief back via my self-assessment, and this will in turn reduce my tax bill for January 2026. So for me, in my situation, it was a no-brainer, but of course, tax treatment does depend on your personal circumstances and may be subject to change. This is just what I decided is best for me. I know some people have put off SIPP contributions due to the pension access age, but to be honest, I'm sure you can understand that I'd rather have that money sat in my SIPP than having a higher tax bill. Okay, going back to the portfolio page now, we can see that the maximum performance view is a bit messed up now due to having a very small contribution of £100 when the InvestEngine SIPP first launched. So it does distort the time-weighted return, but it is correct, it's just how it's turned out here. I won't go into too much detail about the positions here as I did cover it very recently, but I did decide to make this portfolio super simple with just a global tracker, SPDR MSCI All Country World Index ETF, which is currently the global ETF with the lowest TER on InvestEngine at just 0.12%. And then secondly, the LNG RTWP ETF that gives me exposure to US small caps, which of course has not had a great start due to that recent rate cut news. I chose to include this to give me that additional exposure to small caps, which are absent in most global trackers as they only contain large and mid caps, but also because US small caps remain relatively reasonably valued when compared to large cap stocks. Last thing to note here is you can see I have a savings plan of £100 per month set up. I've set it at this level because it allows me to keep regular contributions to the SIPP, whilst also keeping it at a level that is manageable for me and keeping open the possibility of additional top-ups if and when I'm able to, or when I feel it is optimal to do so. So that's the update for my DIY ISA, managed ISA and DIY SIPP. The last thing I want to show is the overall analytics of the portfolios together, as I do think it's really interesting to see and it is one of the unique features of InvestEngine. You can see here on the analytics tab I have it set to all portfolios, but you can of course do it for individual portfolios as well. My total balance is £28,396.20 and it is 100% equities. At the moment I have no plans to add bonds or commodities either. The regional breakdown shows I have 66.1% invested in North America, or nearly 19k in cash terms, 11.4% in Europe excluding UK, 3.9% Asia ex Japan, 3.7% UK, and so on. And then if we switch across to the holdings, you can see my largest positions are Microsoft, Apple, and Nvidia, which everyone will be pretty familiar with seeing at the top of anyone's portfolio. However, beyond that, due to the quality factor ETFs I hold in my main portfolio, the weightings given to companies do differ slightly from what you're used to seeing in a standard global tracker, with Visa, Meta, and Procter & Gamble following. As I always say, I really like seeing how much money I have indirectly invested in all these companies. It makes the process of investing in ETFs feel more real and exciting, as you do indirectly hold a piece of all these giants. That is it for this video. I'd love to hear your thoughts in the comments below and how your portfolios have done this year. I may make another video looking at my portfolios in review through the year and how it is compared to other things. Let me know if that would be of interest. Overall, I continue to be happy with the portfolio and I'm excited to see what 2025 has in store for us. If you enjoyed the video, please consider leaving a like and I'll see you in the next one. As always, thank you for watching.